Let's talk to Marc Ostwald. He's a strategist at ADMISI. Very good morning to you, Marc.
Good morning.
Are you as stressed this morning as the markets?
Well, I think what we've seen this week really is something of what I would call a reality check. If we start on having a look at some of the charts, one of the big mover really that we've seen over the past couple of months has been the US 10-year yield.
Yeah.
But for quite some time, basically a lot of the risk asset classes were ignoring this rise and pretending like it really wasn't going to have an impact either on equity indices or indeed on high yield bonds. But it sort of gradually got to the point where the rhetoric coming from the Fed that they're basically going to stick with their rate hike trajectory and we'll probably get to, I guess, somewhere like 3.25% by sometime early in 2020. And people are suddenly realizing that that obviously has implications for other asset classes. As has been the case for a number of times this year when we do get big rises. And I think the important point here is we've broken through the previous highs. This is a much longer term chart. So from 2012 onwards, we are through the levels that we got to in 2013. And we're obviously through the levels that we were earlier in the year. So let's have a look at some of the impact here that we've had. If we move on to the VIX, obviously, I think the simple question here is, first of all, it is October, and the seasonal pattern for volatility shows, other than 2017, a very strong uptrend, a tendency for the volatility indices to start to spike in the October, early November period. So we've got two questions. First of all, is this just another episode like Volmageddon back in early February, and by the time we get to mid-November, it's all forgotten, and it was much ado about nothing? Secondly, to what extent is it just seasonal, which it also would point to the idea, or is it something more serious? And I think obviously really the key in all of this is really how badly people have been caught in certain positions. We've certainly seen, I don't know, the chartists keep on talking about the great Hindenburg omens. I don't know how many we've had over the last...
Too many that haven't worked.
Yeah, they almost come sort of like come around like a bus. So that's going to be important to see if we see any major fallout there. I'd expect the volatility to remain somewhat elevated, though probably not at these sort of levels. So let's have a look at some of the other indicators we've got here. So first of all, this was always the one which was spooking me a little bit. The high yield bond ETF is the one on the bottom, and the S&P 500, which is that resolute march higher other than the odd small corrections. This is obviously far more significant. And as we can see, there is actually a strong correlation historically between the S&P 500 and the high yield bond, both the spread and the ETFs. The ETFs obviously marching in line in price terms, inverted in terms of yields. And crash, bang, wall up. Down comes the S&P 500. And finally, a wake-up call for the high-yield bond sector, which I think I've pointed out on a number of occasions. And if we have a look at the next chart, seem to be defying gravity. So basically, that high-yield bond spread, which is the yellow line, has been in a sideways pattern all year. Very narrow trading range, basically in spread terms, and ignoring the big rise that or the fairly significant rise that we've seen in emerging market bond spreads. I put that down to a certain extent to a case of it being a case of rotation. In other words, we were overly enthusiastic about EM at the start of the year. Then we started seeing all these cumulative problems, be it Turkey, Indonesia, all the problems from the strong dollar. And people rotated into the high-yield bond area, largely, I think, because they feel, quite rightly, that about 40% of that high-yield bond sector is in the energy sector in the States, and the energy sector is, without a doubt, booming, so why shouldn't spreads be tight? But at some point, it really has to check in back with the emerging market bond spreads, and so we've seen that now getting rather more into line, though still not through the highs of the year. So one has to be a little bit careful here talking about, oh, this is a massive risk-off move, because we're not even through the highs. We could get through the highs, I should stress, but and we should really go quite a bit higher to get it better aligned with the emerging market bond spread. So this leaves us all in the situation of, well, how is this going to impact the Fed? I think one of the false narratives that the market has, and if we have a look at the final chart that we've got here, which is the US Goldman Sachs Financial Conditions Index. Now, when that chart is towards the low, we've got very loose financial conditions,
Right.
and at the highs, it's getting tight. So this is basically covering the period since the Fed first started hiking interest rates. So ironically, financial conditions have been getting looser and looser and looser. What one can see, however, is that when we do have these spikes in volatility, some widening in credit spreads, rise in US Treasury yields, it does start to impact. So when would one think that the Fed might start to think, hold on a minute, financial conditionings are starting to tighten too much for us. We're feeling now uncomfortable. Maybe we ought to think about a pause because things are tightening up a bit. Because one of the reasons they've been able to carry on as they have is because financial conditions are loose. So they feel, well, why shouldn't we carry on? Because there isn't actually any sign that we're creating any stresses either in the financial system or indeed in the economy. But if we got this index to above that 100 level on the chart, I think we probably start to hear a number of Fed speakers say, actually now, finally, we are seeing financial conditions starting to tighten. But we're not there yet, not by a long chalk.
On that note, Mark, thank you very much indeed.